Hello there. Thank you for joining us on today's edition of Business Nigeria. These are the stories we're tracking for you at this time. Finance Minister hints at interest rates cut amid easing inflation. Federal government threatens to revoke licenses of dormant oil blocks. United Kingdom GDP rises 0.3% in November, tops expectations. Let's go to our first story now. Minister of Finance and Coordinating Minister of the Economy, Wale Edun, says interest rate cuts may come soon if inflation continues to ease, a move that could reduce debt servicing costs and ease pressure on Nigerians' strained public finances. The minister said this during an interview with Bloomberg on the sidelines of the Abu Dhabi Sustainability Week. The signal comes at a time when Nigeria's budget is heavily burdened by debt servicing costs, volatile oil revenues, and a widening fiscal deficit, making any ease in borrowing costs materially important. He, however, commended the Central Bank of Nigeria for what he described as excellent progress in curbing inflation, attributing recent improvements to aggressive monetary tightening implemented over the past 2 years. Mr. Edun said a sustained decline in inflation would create room for additional rate cuts, helping to reduce borrowing costs and easing the government's debt servicing burden. Crude oil prices slid more than 2% in early Asian trade today after U.S. President Donald Trump said killings in Iran's crackdown on nationwide protests were stopping, tempering concerns over military actions against Iran and supply disruptions. U.S. West Texas Intermediate crude rose to $59.91 per barrel, with a price decline of 3.40%. Brent crude futures sells at $64.22 with a price decline of 3.46%. Bonnie Light sells at $78.62 per barrel with a price decline of 2.84%. For the OPEC basket, dealers offer $62.75 per barrel with an uptick of 1.67%. Well, as Nigerians and the business community awaits the release of December 2025 headline inflation figures, the National Bureau of Statistics says the data may show a temporary or artificial spike driven by a technical base effect. The NBS explains that the expected increase does not reflect underlying inflationary pressures, but rather a one-off statistical adjustment resulting from the rebasing of the Consumer Price Index. The rebasing, the first in 15 years, sets December 2024 as the index reference point, a move officials say would distort December data without reflecting actual price trends. December inflation data is due to be published this week. Analysts are predicting a sharp rise in the headline figure to 30%. To help us understand inflation figures for December 2025 and other development that will shape 2026 is a director, research and strategy at Chapel Hill Denham, Tajuddin Ibrahim. Thank you so much for joining us at this time.
Thank you for having me on the show today.
All right, so the NBS has warned of a possible technical or artificial spike in December inflation due to CPI rebasing. Can you explain in simple terms what this base effect means and why it matters now?
So the base effect is a reflection of arithmetic impact on the consumer price index. Bear in mind that the consumer price index was rebased last year to further reflect new elements in terms of product, new services that we have in the country. So what they did was to rebase the consumer price index to as far back as over the past 30 years or thereabouts. So we currently now have a situation where we are using the latest, rebased consumer price index, and it was rebased to 100 points for 2024 December. And it is from that level that we began to calculate the increase in the consumer price index for the month of January 2025, February of that year, and up until November of 2025. But because we have what we call base effects, we are most likely going to see inflation for the month of December 2025 being announced at around 31%. While that is not a reflection of economic activity in terms of demand and supply of goods and services, it is a reflection of arithmetic impact on the consumer price index. So the National Bureau of Statistics is working around removing the impact of the rebasing because it is not as a result of the impact of the forces of demand and supply. So what they are doing is what we'll call normalization of the consumer price index to reflect genuine economic activities that really drove prices in December and not artificial elements that arose or that is arising from arithmetic calculation of the consumer price index. That is what they are doing, and much later this week, I reckon that the adjusted inflation number will be published and will be consistent with the numbers that we've been seeing in the past couple of months, which is around 14-15% inflation number on a year-on-year basis. What is interesting to bear in mind is that this adjustment is one-off. The moment it's adjusted, from January of this year onward, we will continue to see the number in terms of the CPI, inflation, numbers. But this adjustment is just to remove arithmetic impact, which is not a reflection of economic activities.
All right, so if the headline inflation rises sharply to around, like you had mentioned, 31%, as some analysts are predicting 30%, how should Nigerians interpret that number? Should they be alarmed?
I think the number will be misleading if we are to be looking at it because it is not driven by economic activity. It is just, something that, possibly will arise on the back of the arithmetic, impact of the consumer price index rebasing. So I reckon that the public, the policymakers, and some other users of economic data, particular, inflation in this case, should focus on what the National Bureau of Statistics would call adjusted inflation. That is what we should be looking at, and I reckon that that number will not be more than like 15 to 16% when it is published, because it is on the basis of that policymakers are going to make policy. It is on the back of that investors are going to make investments to see how much they can beat inflation in terms of generating real return on investment. So I reckon the public should focus on the adjusted number and not so much on the number that is influenced by arithmetic calculation.
All right. So does this rebasing change the way we should compare December 2025 inflation with previous months or years?
So if we're looking at the adjusted inflation number when it is published, it will be consistent with the numbers that we have been seeing since the beginning of last year. So it will not be materially different because the base effect impact will have been removed, and it will allow us to see the real impact of economic activities in terms of the impact of spending, consumer spending on goods and services, in terms of supply impacts to the market with respect to various products, be it food products or non-food products. All of those elements will be reflected in what I would describe as adjusted inflation number for December 2025.
All right, so do you think the MPC will focus more on core inflation and month-on-month trends rather than the headline number going forward?
So the interesting thing is that in terms of the the way that they are looking at the adjusted inflation number, the MBS disclosed that they already had worked with the Central Bank of Nigeria, they had worked with the World Bank, they had collaborated with the IMF to sensitize them, to let them know that, they are coming up with what is called, the adjusted inflation number. So I believe that the Monetary Policy Committee of the Central Bank of Nigeria will be looking at the adjusted inflation number, and that number, to my mind, could come as low as 15% or thereabouts, and it will be a reflection of a real positive monetary policy rate for the country. Bear in mind that we have 27% as our policy rate. When inflation is announced at around 15% for December, the Monetary Policy Committee will be comfortable to begin to think in the direction of cutting interest rates, particularly if the downward trend is sustained when we enter February and January inflation is announced. I reckon that the Monetary Policy Authority will be a lot encouraged to begin to consider cutting interest rates further. Remember that in September last year, they cut the monetary policy rate by 50 basis points. I believe that there are opportunities for them to also cut interest rates further this year, particularly if inflation continues to trend downward. And I think there are no compelling reasons that will not make inflation to trend downwards in 2026.
All right. So could this rebasing complicate interest rate decisions in early 2026?
So it actually should be positive for interest rate decision, because if the previous number, which is arithmetically influenced, were to be published, which is about 31% thereabouts, that number will be negative for policy decision with respect to monetary policy, committee of the CBN. But since that is not going to be the case, and the CBN is already sensitized, I reckon that the focus will be on the adjusted inflation number, which to my mind will not be beyond 15 to 16%.
All right, so beyond the base effects now, what are the real inflation drivers Nigeria should be watching for this year?
I think we should be watching for elements around, number one, food prices. And I say food prices because of the big weight it has in the consumer price index. And the broad expectation for us is that we should see another good year in terms of local food supply. Because last year we had substantial harvest underpinning the way that our inflation trended last year. Particularly, we had 2 months of negative inflation, particularly on food inflation, so which is a good thing, and it was driven by higher supply of local food. So if the government can, keep the momentum high in terms of ensuring that food, local food, particularly in this case, prices are lower or at least stable, then we can be talking about much lower inflation in the coming months. So we should watch out for food prices, which will be largely influenced by the harvest of farmers in the country, particularly in food producing regions of Nigeria. The second element to my mind for consideration is foreign exchange rates. Foreign exchange rate is one thing that also fits into how Nigeria's inflation number behaves. So it goes much higher in a period of volatility, let me say enormous volatility in foreign exchange rates. But in 2026, we have been seeing an improvement in our exchange rate. In 2025, for instance, the Naira appreciated by about 7% against the US dollars. And coming into this new year, there are strong indications that that appreciation will be sustained, particularly considering one key element which I like to speak about, which is import substitution. import substitution has really played a major role in the way that our import bill has been largely influenced. And when I say import substitution, I am speaking basically to the premium motor spirit, which is petrol in this case. Yeah. Now we have localized all of the value chain of petroleum products in the country. We produce, we extract the crude oil locally, we refine locally, and we sell locally. Interestingly also, we sell refined products to other markets outside of Nigeria, generating foreign exchange to underpin the performance of our currency. I think FX rate is another element for consideration, and the outlook is positive in the coming months.
All right, so what role will exchange rate stability, fuel pricing, and food supply play in shaping inflation this year?
So it will shape inflation positively by making sure that inflation, comes down, from current level. So it will make inflation to trend downwards. And there's a positive expectation around the result. When you have inflation coming downwards, what most likely you would see is that the Monetary Policy Authority will bring down the policy rate, which is currently at 27%. Bringing down the policy rate means that banks would have to bring down their borrowing or their lending rate. When banks bring down their lending rate, you are going to most likely see more businesses coming to the banks to borrow money to grow their businesses and support all of the growth ambition that they have. A lot of businesses, as we speak, particularly those in the manufacturing sector, are finding it difficult to access cheap funding. So if we have lower inflation in the country on the back of much lower food prices or stable food prices, and on the back of the appreciation of the exchange rate, it is going to lead into lower borrowing rate. Lower borrowing rate most likely will lead to the ability of more businesses to borrow money for growth. When they borrow money for growth, they expand their businesses. When they expand their businesses, they create more jobs. When they create more jobs, the pension industry, from that standpoint, is also going to grow at a faster pace because there will be pension contribution onward. When you have all of those elements in place, you are going to grow the entire economy as a whole. Those are the expectations I have in terms of how lower food prices and exchange rate stability or appreciation can play out and have positive impact on our economy over the next couple of months.
So what about inflation trends? Do you expect it to go downward in 2026, or are we likely to see continued volatility?
I think what most likely we would see is for it to go downwards based on the internal numbers, that we are forecasting. The only, risk that we may see are what I can call exogenous, factors in this case. We may see external, shocks. Those external shocks are things that we really cannot control as a country. Let us say, for instance, oil prices plummet significantly to below $50 per barrel. That will require the central bank to begin to think about how to support the currency. And you can support your currency by ensuring that you have elevated interest rates to make your local market attractive for foreign investors to come and bring in US dollars to support the demand-supply dynamics in the market. So in such an environment, you wouldn't be able to bring down interest rates as a central bank. Rather, you most likely will keep it stable, or you may even have to increase it, and that will dampen the performance of the economy as a whole. I see little or no element around endogenous factor, but there are factors that could be exogenous in that context.
All right, so let's look at the Central Bank of Nigeria having projecting that Nigeria's economy will grow by 4.49% in 2026 as against World Bank projection of 4.4%. How achievable is this projection?
I think that number is achievable. My message to the regulators or to the authorities in this case is that they should ensure that all of those sectors that are the lifting sectors in terms of economic growth do not suffer any form of setback. And I give you, examples in this case. One of the major drivers of the Nigerian economy is the telecommunication sector, because that sector is still rising in terms of growth, as we are seeing demand for telecommunication services. If there are regulatory factors that can hinder the growth of that sector, it is going to reflect negatively. And a 4.49% or thereabout economic growth is not going to materialize. The financial services sector is another one. I believe that authorities should ensure that they monitor regulation in that space and ensure that it does not distort or slow down the growth of the financial services sector, because it brings to the table a lot more compelling element when we talk about the overall growth of the Nigerian GDP. The fourth sector to my mind is the agriculture sector. There should be deliberate effort around ensuring the security of lives and properties, particularly in food producing areas. When that is taken care of, I believe that output by farmers can be a lot robust, and with a lot robust output, you are most likely going to see it positively reflecting on your GDP. Don't forget, in the third quarter of last year, the agriculture sector was the fastest contributor or the highest contributor to the expansion of the Nigerian economy in the third quarter, which means that it is one sector to really pay attention to and ensure that policies are deliberate in terms of implementation to support the activities of farmers. So I believe all of those elements are very, very important. 4.4% is achievable, but we have to bear in mind the activities of regulators in all of those sectors and how the government supports, particularly the agri sector of the economy.
All right, so finally, what key message should policy makers, investors, and ordinary Nigerians take away from the December inflation data?
I think one thing that they should take away from it is that the data will be reflective of economic activities, and it will be devoid of arithmetic impact or distortion. So it is very important, because policymakers can rely on the number in terms of policy decision, and investors can also rely on the number in terms of making investment decisions. I think those two key elements are very important.
All right, Director Research and Strategy at Chapel Hill Denham, Tajuddin Ibrahim, thank you so much for talking to us.
Thank you for having me on the show.
All right, now, still to come on the show, we will shift our focus to examining geopolitical concerns and impact on economic growth and development. Finance expert Bolahan